the bank.
All right, Brett, how many people were delinquent on their credit cards? And delinquent meaning it took them 30 days or more to make up a missed payment.
Of all the people that have missed payments, or all the people that have
all the
credit
people
cards?
that have credit cards, how many are delinquent on their payments?
15%.
2.96%.
No way.
In fourth quarter
Everybody
2019.
is awful with credit cards.
By 30 days or more, though. So if they're like 15 days late, then it doesn't count.
People are just super delinquent. It's my assessment of society.
So, I mean, I picked this question because I knew it would surprise you. I was like, he's going to overshoot this one like crazy.
Well, good people that aren't in debt as much as I thought for credit cards.
Well, at least they're making payments. That's good.
The minimums, right?
Hopefully, or a payment. I don't know. It didn't say like...
Didn't specify. See, your trivia questions are just too tricky.
You know, that Google. So today I actually wanted to kind of talk about credit scores again. And you might be like, hey, you've already done an episode about credit scores. Some things are changing. Right now, the rules that they use are between like FICO 8 and FICO 9, right? And so mostly a lot of people are still like TransUnion, Equifax, Experian. They're still kind of relying on old like FICO 8 analysis.
Okay.
And now they came out with FICO 10. And it takes some time to move over this. It's not going to happen immediately. And it might not happen for all lenders for like years because sometimes they like to know that this works. But Experian is looking to build this in the summer of 2020. And Equifax and TransUnion are looking to build this in by December of 2020. So there are going to be some changes coming in. And again, like they might not end up sticking with it. It might kind of be like a secondary measure at first, but we're going to be moving in this direction. So I just wanted to kind of get on here and update people. What does this mean for you when they change the formula behind the scenes of this, like, nobody knows how to actually sit down and calculate their own credit score?
Right. Let me tell you how I feel about the credit scoring industry inside the United States.
Oh, yeah? How do you feel about it, Brett?
It's really awesome.
Yeah?
It's my favorite.
Fantastic?
Yeah, it's my favorite industry that's behind a black box that nobody understands and nobody knows about. And even the people that have to regulate it on the front side, like the credit card companies, have a hard time understanding what is calculated on the back end. And it's all just a big wobbly mystery, and you don't know how to game it because they hide all the rules.
Right. I mean, it's basically like they throw all this stuff into a hat and then they pull out a 3-digit number, right?
Right. And everybody has a different 3-digit number. Because the one that you pull up from like creditcardama.com or like this part of mint.com or the ones you can pull up for free, maybe that's not even the right number. They're taking totally different data from what those are.
Because the credit bureaus all calculate them differently, right? Equifax, Experian, and TransUnion all put their own little twist on things.
Yeah, it'd be really cool if they just like came up with one system and it was like very clear that like I could do these things and I could have a good credit score. And like,
well, I can help you with that.
All right.
So if you pay your bills on time and you don't have a lot of debt and you've had credit cards or different loan accounts for a long time, you're going to have a pretty good credit score.
Unless you close old credit cards or if you don't have like 4,000 credit cards open simultaneously.
That has a low weighting on your credit
Then you're a
impact.
delinquent, right? Yeah. If I only, like it's all a system geared toward people having more credit availability and danger and risk than they should have. In
yes
my
and
opinion.
no. Yeah, okay. So the big ones that you touched on are making on-time payments is like the number one factor.
Okay.
And keeping your age of credit history up. So you did mention closing old credit cards can be detrimental because it shortens your credit age, right?
Let me tell you how I know.
Yeah. But the benefit is, I think some of these changes that they're trying to implement are actually looking at more historical trends. So let's say I had a mortgage, I bought my first house in 2013, and I made all of those payments on time. It's actually beneficial for me if they start looking at that trend because then they say, oh, even though this account was closed, when it was open, we have more years of on-time payments, right?
Uh-huh.
So that would be a good change. That would help you out.
Well, all right. So should we start going through the list here and figuring out what's good and what's bad?
Yeah. So I think, the biggest thing that I'm seeing is for credit cards, like I said, they're going to start looking at that trend. So it's going to be really important. We've always said this, but you want to keep your utilization below 30%. And basically what that means is if you have a credit limit of $1,000, you shouldn't put more than $300 of charges on that card at any given time. And if you do, let's say you're like, oh, I got to go and I got to buy a new dishwasher for like $500 and I already have, $300 of groceries on there or something, and it gets up to $800, you should pay that down like the next day. Right. Don't even wait for the statement to post. Pay it down before it can, because that will really help you, because now they're going to look at a trend. So they're going to say any month that your utilization was over 30% in the last 24 months, we're going to keep a record of that.
Right. So it's going to bump it up, right? So they're looking at more data points than they used to, right? The back-end systems, they have access to more storage. They're going to store more data for your account, just like the energy companies are doing with net meter or like metering.
Smart metering,
metering, digital metering, right? You can like log into that website and like you can see in real time like what your energy usage is every day. That didn't used to be the case, right? Some guy used to come to your house and like maybe he would come to your house and he would just like check it point in time, right? So we're moving from like that point in time system where somebody just like occasionally looks at your stuff to more actively monitored trend analysis, data management, right? Big data analytics for like your credit history.
Which makes sense because I feel like every industry is utilizing big data analytics more and more.
It's
that's
there.
The way
have
of the
access
future.
to it. Every company should be looking at this stuff. And I think that's a good thing, right? I think like looking at the more realistic picture rather than point in time analytics is a more accurate representation of what is actually happening, which should be good for both parties.
Right.
Unless you're super delinquent as a person and then you just have bad credit and that's the way it should be, right?
Right, but I would say if you have a lot of credit card debt and you're on a debt payoff journey and you're working to pay down your credit cards, it's also beneficial for you because they're going to see that history of your debt decreasing month over month, and that will be a good thing. So even if your utilization is still, let's say your total credit limit is $10,000 and you've racked up $8,000 of credit card debt, and that's a lot, right? You need to get that under $3,000. But if you're making $1,000 a month progress on that, even if it takes you, the 6 months to drop under that $3,000 threshold, you're still going to be kind of getting a little bit of improvement every month because they're seeing that you're paying that down. Where you're going to get hurt is if you start ratcheting that back up. So a popular method for credit card consolidation is to take all this credit card debt. Let's say you have 4 different credit cards, and in total you have like $50,000 of credit card debt. A lot of people will go ahead and just take out a personal loan, which is a smart thing to do because you can go from having like 20% interest to, let's say, 10% interest. And then you can work on paying that down. And that will be a good thing, right? If you pay it down. Where it will be a bad thing is now if you get that consolidated and you're like, oh, but now I got these credit cards that have no balance on them anymore, and you start swiping, and then you rack that back up, that's going to hurt you even more under the new system. Right,
because now you have 2 like big problems that are surfacing, right? Yeah,
right.
So, yeah, it looks like you were doing the right thing, and then you spike it back up in the wrong direction. So, and hopefully, right, as a creditor, as like a bank or an auto lender or whatever, right, a mortgage company, I wouldn't be just looking at some like fictitious number on the back end. I'm going to be looking at like key performance indicators, right? KPIs for like that trend analysis. Are you trending in the right direction for these things? What is your debt to income ratio? Like what are some key markers that are going to tell me like you're doing things right?
Right. And I think enough lenders and like landlords were doing that on their own that I think that's part of the motivation behind these new FICO 10 rules is they're trying to analyze all that KPIs and get to a number that makes more sense. Mm-hmm. And so, yeah, I mentioned the personal loan. That another kind of important distinction is personal loans and credit card debt are now going to be viewed a little bit differently in the equation compared to mortgage or student loans.
Okay.
And the reason for this is those personal loans and those credit cards, that's kind of thought of as like unsecured debt because there's no like with a mortgage you have a house backing it up, and it's also debt that it's like your discretionary spending. Mm-hmm. So you choose to kind of take that on. And I know some people given the circumstances, maybe they have to put some money on credit cards. I understand that, but that's how the credit agencies are going to start viewing this is, well, that's, not like for your education or for a house. And so they're going to kind of view that as like good debt and bad debt to a certain extent. To what extent, I don't know, because nobody knows.
Right. And, I don't know. I tend to agree with thinking that's a good thing, or more accurately, the right thing. Because, it's a lot safer if you have a contracted loan with a mortgage lender, or you have a contracted loan with an auto dealer or a bank or a credit union, right? To like have those kind of like secured loans that you've like really signed up for, you've really committed to that. You like it's a more formal process to like go through that and get approved, and right, it's a very rigorous process. Spending money on a credit card to get the same debt racked up is very easy to do, and like there's no barriers to that.
I agree. The interesting one to me is the personal loan classification.
Sure.
Because you do go to the bank and you do go through a more rigorous application process where they review everything and issue you a loan. And I think the problem with it is, people are taking those out to consolidate credit cards, and then like I mentioned earlier, they're racking debt back up on the credit cards. Mm-hmm. Or they're taking it out for, home improvement projects that maybe half the money gets spent on the home improvement project, half the money gets spent on something else because it's a personal loan, so nobody's actually controlling it.
Right, or stuff for the house, right? Like
right.
New couches and tables and chairs and all that
exactly. Stuff. So just be mindful of that, because I know people, there's varying, I think, levels of personal loans out there. So it's kind of tough to put it all in one category, because the people who do consolidate their debt with it and then pay it down, that's a great use case for it, right? Mm-hmm. But, kind of know that you will get rewarded for that, but you will get penalized if you don't do that.
So. Right. So that'll be an interesting one to monitor going forward, though, right? So
yeah.
Once this plan is actually put in place, to see if people are negatively impacted by that and how much.
Yeah, so two of the biggest things that you can do under kind of this new regimen is to definitely make on-time payments and pay your bill in full if you can for your credit cards.
So that's something you said at the beginning, was like making on-time payments consistently is like the biggest factor, right? Or one of the biggest factors that they're going to be looking at.
Yeah, it's always been a big factor, and now it's like even more important.
Okay.
And then I also just wanted to note that people might be saying, okay, well, how much is this actually going to change my credit score? And so initial reports of, people who are working on this say that basically the rich are going to get richer and the poor are going to get poorer. So if you have a good credit score already, it's likely just going to get better. And by good credit score, I mean above 670.
Okay.
And if you have a bad credit score, it's likely going to get worse. And by that, I mean about under 580. And so they're saying up to 20 to 35 points people can expect to see.
Wow, it's about time. I could use some more points anyway.
Right. So, but I think just something to kind of keep in mind, since we do have time to prepare, anywhere between 3 and 9 months before this will be kind of early adopted by the credit reporting agencies. If you're on that lower end of the spectrum and you're like, hey, I really don't want to go from like 580 where I'm like, almost to 600 and I've been working so hard for that, and fall back down to 560. Like, I feel I can understand how that would be very defeating when you've like worked hard to kind of dig yourself out of that.
Right. Especially for people, right, like we talked about before in a couple episodes ago, for like identity theft, right? And somebody like goes in and like just tanks your credit rating, right?
Right.
From just like false claims and just buying stuff and opening credit cards and submitting rental applications and all kinds of junk, right? And we personally know many people that have been in that situation. So, right, you still have time to get out of that boat before you are going to be negative 20 points, right, from this new system.
Right. So, I would just recommend over the next kind of 3 to 9 months, and even after that, it'll take some time to get put in. So really over the next year, you could have 12 months of on-time payments if you don't have that already, right? Mm-hmm. So if they're looking at 24 months total, let's say you've had 3 missed payments in the last year. Well, now it's only going to be 3 in the last 24 months, and then those will slowly fall off, right? So your credit score will go up and up and up. And another really big thing that you can do is And something I actually do and I recommend, I had somebody ask me recently, like, should I increase my credit limit? Why would I do that? I've always been in the practice of the one credit card that I have through Citibank. They let me just log on and it's a soft inquiry. Every 6 months, I can request a credit increase. And I've done that since I got that card when I believe I was 19. And the benefit to that is now that credit limit is fairly high. So that means that I have more money that I can spend before I hit that 30%. So Brett and I are in the habit of, we put all of our monthly expenses on a credit card. It makes it really easy to track our spending and we get cash back. And the other benefit of buying things on a credit card instead of with a debit card is fraud prevention. To be perfectly honest, if somebody steals my credit card in like a gas station skimmer and buys Super Bowl tickets, ask me how I know, I can go ahead and I can call my credit card company and they will take that charge off. If it's a debit card and they get that debit card and the money's out of my account, it can be much, much more difficult to get that back.
If at all.
If at all.
It's very unlikely that you will get it back.
Right.
Once that money is spent out of a debit account, then it's probably gone.
Right. So credit cards actually can be safer to use than debit cards and, you know, offer benefits of like cash back and stuff like that. So we put everything on a credit card. Well, you know, our monthly spend between groceries and bills and all sorts of stuff is anywhere from between $1,500 and $2,000. So when I was younger and my, you know, credit limit, I think on my very first like Chase credit card, I think I got like $1,000 limit. I would have had to like continuously pay that off after every purchase, right?
Right.
And that's a huge pain in the butt. I personally am somebody who likes to pay it once a month when I get the statement and, you know, auto pay, set it and forget it. And so by having that higher credit limit by every 6 months, and then they see that I've made on-time payments, they increase it a little bit, then I can go ahead and increase my credit limit to the point where I don't have to do that anymore. I can pay for all my monthly expenses, and then I can pay the card off, you know, every single month, and it's fine.
Right.
Instead of having to do it more frequently, which is kind of a pain in the butt.
Yeah, I'm in kind of a weird situation since I was traveling for work for such a long time. All of my like hotel expenses and everything were all on my personal credit cards because then I get points, right? And then I just bill in the expenses, which is a great model for like building points and credit card hacking and all that fun stuff. But it also really inflates your spend when you're staying in a hotel 4 times a month, right? For like a couple $1,000s for that, right? It really adds up quickly if you don't have like super high
Credit
limits
Yeah.
or limits on those credit cards. So right, you just got to be careful of that. I wouldn't want to get burned from that scenario by exceeding my 30% utilization,
right?
Because of my job, right?
And so, you know, in that situation, that's a unique situation where maybe you have to keep an eye on it and pay it every 2 weeks. You know, when you get paid and you get reimbursed, just go ahead and pay those expenses off. But the other thing I want to mention, so like I said, with Citi cards, I know they do every 6 months I can log on and it's a soft inquiry to my credit and then they'll decide if they can increase it or not. Some credit card companies will say that they need to do a hard inquiry. I do not recommend doing that. So if you can get a credit limit increase by doing a soft inquiry, go that route. If they're like, oh no, it's either you haven't been with us long enough or you don't have enough history or whatever their reasoning is and they say that they would need to do a hard inquiry first, I would advise against not doing that because one of the other factors on your credit score is hard pulls. And so that's when they like really check your credit, you know, and you want to limit that. You typically don't want to see more than 2 in any 2-year period. You know, when my credit got hacked, I had 17 in 5 days, so sweet. So, you know, you kind of want to limit that. And anytime you apply for an auto loan or a mortgage or a rental or a credit card, that's going to be a hard inquiry. That application is your giving that company the authority to do a hard pull, right?
Right. And regardless of how stupid that sounds, that somebody that you've authorized that is a trusted agency to look into your credit history to be able to approve you for like loans or whatever it is, why that would negatively affect your credit is beyond me. But that's currently the way the system works, right? So
Right. But I will kind of note that, like, let's say you're looking to buy a car or a house and you want to shop around for the best rate. Go ahead. That's not going to hurt you if you're doing it in the same time period.
Right.
So if you go to 3 auto dealers, in the same week, and you're like, what's, your financing rate, or maybe you go to a credit union and you ask them all to, like, give you their best rate, that's going to basically count as one pull.
Right. Same with apartment or rental. If you're going to move into a rental somewhere, typically you get a credit background check when they do that, which is a hard pull. And you have, like, I think it's a 45-day window. The last time I looked, of anything you do within that 45-day window counts in the same pull, right?
Right. So don't let that scare you off of, like, shopping around for the best rate. That's still really good practice to go ahead and do that. But just kind of keep that in mind. If you are credit card hacking, for example, you don't get that same grace period with credit cards. It's not like, oh, I'm going to apply for 15 credit cards in a 45-day window. Like, no, because you could get them all, right? With an auto loan, you're only going to get one.
Right. You hope.
Well, you could get approved for multiples, but you're going to pick the best one, right?
Yep.
And so with credit cards, when you submit that application, that's going to be a hard inquiry. And that's just a good reminder for people. So I think that's most of what I wanted to go ahead and cover with this. Not a ton is changing. It's really just kind of, they're going to be looking more at trends instead of point in time. And they're going to, really kind of weight a little bit differently having those credit card debts and personal loans compared to, what we consider good debt, which is like mortgage debt.
Right. So I'd say some of these are moving in the right direction. I still fully don't agree with the system whatsoever, but at least they are talking more about what some of the factors are that are going into it, even though how they calculate some of those factors is still pretty wishy-washy on the back end.
Yeah, I think one of my biggest problems is if you turn 18 and you rack up a bunch of credit card debt and you don't pay it off right away and you make this mistake and your credit score tanks, it can be, like, really hard to dig yourself out of that hole for, like, 10 years. Like, even by the time you're, like, approaching your 30s, you can just still have, like, a pretty low credit score. And so I would like to see, where we move to a system where it's like, if you make one bad mistake, because I know, like, I've looked at Credit Karma before and it's like on-time payments, and mine's at like 100%, so I get an A, but it's like, and then it shows you, like, what would your grade be, and it's like, with one missed payment you drop to a B, and it's like, maybe we should be like, hey, sometimes, like, maybe somebody forgot to, like, send it in right away,
right?
But, like, let's not, like, ruin their credit score for the rest of their life. Like, mistakes happen.
Right. I mean, I had autopay turned on with Comcast like 10 years ago or whatever, and it just didn't process. And they, like, tried to, like, bill me extra and say I had a late payment. I'm like, no, dude, this is your system. There is no way I'm taking responsibility for your stuff. But, right, that would have gotten passed through as, like, a delinquent payment if I wasn't, like, monitoring that stuff as, like, oh, you didn't pay your Comcast bill this month. Like,
well, when I was in college, I had 2 bank accounts. One like a local bank and one an online bank. And I had everything set up through my online bank to, like, pay my credit card bill every month. And my online bank just, like, froze my account without telling me at one point. It was kind of like a case of mistaken identity. They didn't actually mean to freeze my account.
Oh.
And if I didn't catch that in time, then, like, the payment wouldn't have gone through because no transactions could go in or out. And luckily, I had another bank account that wasn't frozen that had enough money in it to make that payment.
Mm-hmm.
But, like, right, there's all these, like, weird one-off situations where I just feel like sometimes you can, like, have a couple bad things happen to you and it's just, like, this spiral. So, if that's happened to you, I feel for you. I feel like this system can make it really difficult to climb back out. And I'm hoping that if they do this kind of, like, 24-month prior history window, then hopefully they don't, like, it'll just kind of, it gives you that 24-month rolling period to really, like, prove yourself.
Right.
Or, instead of, like, 7 years.
Right. And show that you're trending in the right direction and you're doing everything right. And, like, they can clearly see, like, oh, there was, like, obviously, like, one big problem with you, right, or with this situation, and then all of the rest of the data checks out perfectly.
Right.
Right now, the data that they have in the back end is, like, very ambiguous for your account. It's just like a couple of check boxes here and there, or a couple like numbers that are thrown up on the screen. And like, so it's very hard from a creditor's standpoint to like make an accurate assessment. And a lot of tools, because right, we're landlords, right? So when we get like credit score background checks back, we don't get a lot of raw data from the systems that are coming back. We get a lot of like, here's this like graph, and like it's like a speedometer, and like, is it in the green or is it in the yellow or is it in the red, and like, what is this garbage? Like, give me data points.
Right. And what kind of kills me sometimes is it'll be like 5 missed payments, and then like, you know, sometimes if we see that, we reach out to the person to be like, hey, we saw this, we just want to like, if you don't mind, we want to like ask more. And they'll be like, oh, it's because like I canceled my Verizon account, but they just kept billing me, and like I have AT&T and I can prove that I've like always paid my bill on time, and like Verizon just like screwed something up, which like totally happens.
Oh yeah, and it's like medical payments are on there too. Like they show up as a category. Phone bill payments show up as a category for like who was like claiming that they didn't make payments, right?
Right.
And a lot of times those are the two big offenders. And in many cases where we've talked with people that have submitted like, you know, credit background checks for us for rentals, like we give them the credit report as well, because they should have it. It's their credit report, right? And like they don't know that some of this stuff is even on there.
Right.
Like they didn't know they had a medical payment like that was like outstanding somewhere.
Or, you know, some of the problems, especially in America with medical payments, is like your insurance company was supposed to pay it, but something fell through the cracks.
That happens constantly because you get so many just for like one procedure, right? You've done multiple surgeries now.
Let me tell you how I know.
Every time it's like there's like 16 different bills that come in like a 3-month window,
right,
all over the place just for that one procedure that took like an hour in and out, right?
Right.
So it's like there's like every single person involved in the entire process end to end has their own billing department or something. It's like the dumbest
It's
cycle.
horrible. Yeah. So where were we going with this? Oh yeah, so basically, you know, I just think if we move in this direction of, if we got more information and I could see, oh, this, you know, 5 missed payments was all in the same month because of like a reporting glitch, then that's just like helpful information. We can use that data to be like, your score shouldn't be under 580. It should be over that, right? Mm-hmm. Because this obviously happened like 3 years ago, and we need to stop holding it against you.
Yeah.
And part of it is like we need to clean up reporting metrics, but that's a whole nother rant. Because like, let me tell you, when you're dealing with these credit bureaus trying to get stuff sorted out, it is a disaster.
Yeah. And that's a different episode that we just recorded a couple weeks ago, right? Under the how to not get credit card hacked or whatever, right?
How to not get your credit or identity stolen. Yeah. So go check that one out. It's not fun. It's even worse than getting your credit card hacked, because it's like 15 credit cards.
Yeah, we've had that happen a couple times. And yeah, identity theft, way worse. Way worse.
Yeah. But just for a quick summary, pay your bills on time and keep your credit card utilization low.
Yeah, I think I'm optimistic for like things could be better in the future here as far as the system that I loathe tremendously, right, goes. But right, people need to play inside the rules because that's the system we have. Don't trust these companies with your data to secure it, because we know that they can't and they don't invest in those technologies, as a reminder. So if you need to, if you're not making any big purchases or you're not going to be doing any hard credit pulls, make sure to freeze your credit so that people can't get into this information in the back end and social engineer your stuff and open things in your name and all that fun stuff. And then you can call them and unfreeze your credit when you need to, or do it online.
Yep. Exactly. Cannot emphasize that enough. Freeze your credit, people. It's the best thing that you could do. It's the gift that keeps on giving, even if you don't know it, because not having to deal with identity theft is the best.
Yep. So. And whether you are actively trying to improve your credit or not, definitely use sites that are like free credit services like Credit Karma. We've used freecreditreport.com, I think is another one, right?
The pirate one, I don't recommend that. Freecreditreport.com.
Oh, yeah.
I don't know about that.
Mind.
Don't use that.
Oh, God. Yeah, no, that's not. The jingle just subdued me into recommending them. Stupid advertising. Ugh.
We actually recommend creditkarma.com or mint.com to monitor your credit.
And Mint has it built in with, I think they use Credit Karma as their back end. as well. So
yeah,
but
so
it's all built into the website. So
either
it's
one of
free.
those
Just use that.
is a fantastic service. They're both free.
And they give you indicators of like where you are and are not performing well across the different credit score categories.
Yeah, which always really helped me figure out how to clean up my act. So hopefully this kind of gets you ahead of the curve, gets you prepared for some of these changes, and in general is just a good reminder of how to keep your credit score up. So thanks for tuning in this week. Hey guys, thanks for tuning in to this week's episode of Money in the Bank. Make sure to subscribe to us on the iTunes or Stitcher app so that you get weekly alerts every time we post a podcast. Or if you want, you can visit my website, moneyinthebankpodcast.com. And if you want to reach out with any questions or further comments, please email me at Angie@moneyinthebankpodcast.com. I look forward to hearing from you.
Money in the bank.